If you earn over $70,000 a year, the government has a surprise for you in 2025, and it's not a good one. Starting January 1st, 2025, Canada is introducing something called the CPP Second Ceiling. Translation: if you're a professional, business owner, or anyone with a decent income, your CPP deductions are about to go up. The government says it's for your benefit. But here's the catch. They're taking thousands more from your paycheck and giving you only a fraction back later. Today, I'll show you exactly what this new CPP2 means for your income, how much extra you'll pay, what you actually get in return, and how to legally structure your finances so you win this game instead of funding it. Because while most Canadians will just complain about it, the smart ones will profit from it. Relatable setup. The paycheck shock. Let's say you're a software engineer earning $90,000. You open your first 2025 pay stub, and your CPP deduction suddenly jumped by hundreds. Nothing changed, except Ottawa decided high earners should now contribute to a new tier of the Canada Pension Plan. You worked harder, got a raise, and now your take-home pay drops. Sound familiar? This is what the new CPP Second Ceiling is. A second layer of mandatory pension contributions designed to enhance retirement security. But in reality, it's another form of forced savings with limited flexibility. But if you understand the math behind it, you can make it work for you instead of against you. What is the CPP Second Ceiling, CPP2? Explained simply. Alright, let's break down what's actually changing. Because even most financial news outlets aren't explaining this clearly. Before 2024, you paid CPP on income up to about $60,600, called the YAMPE, or Year's Maximum Pensionable Earnings. In 2024, that moved up slightly. But starting 2025, there's a brand new layer called the YAMPE, or Year's Additional Maximum Pensionable Earnings. Here's what it means. You'll pay CPP as usual on your income up to the first ceiling, $70,000. Then you'll pay a second CPP contribution on the portion between $70,000 and $8,180. So if you earn $81,100 or more, congratulations, you now pay into CPP twice. They're calling it CPP2. The combined rate between employer and employee equals 11.9% on that upper layer. In dollars? You'll contribute about $750 more in 2025, and your employer matches it. Not catastrophic, but here's the thing. Over 10 years, that's almost $15,000 leaving your pocket, compounding for the government, not for you. Why this change exists. The government's perspective. Let's be fair, the CPP isn't a bad system. It's stable, indexed, and professionally managed. But with Canadians living longer, retiring earlier, and private pensions fading, Ottawa needed a fix. CPP2 is designed to give higher earners an extra layer of retirement income. It's supposed to increase your eventual CPP benefit by about $700, $800 per year in retirement. But that only helps decades later. Right now, it's taking liquidity out of your hands. Money you could be investing, compounding, and controlling yourself. That's the key, control. So if you want to stay ahead, you need to reroute that lost liquidity into assets you actually own. The real impact, how much you'll actually lose. Let's do the math. Say you earn $95,000 in 2025. Under the new rules, you'll pay CPP on your first $7,100. Then again on $11,000 above that, the YAMPE. That's about $750 extra a year, or $62 a month. Not terrible, but if you're self-employed, you pay both sides. Now you're paying roughly $1,500 more per year. And over a 20-year career, that's nearly $30,000 of opportunity cost. If you had invested that same money in a TFSA earning 7% annually, you'd have over $80,000 tax-free. See the difference? CPP gives you a defined payout decades later, but you lose control, flexibility, and compounding power today. Who feels it the most? So who's most affected by CPP2? High-income employees between $75,100 and $20,000, they'll see the biggest relative drop in take-home pay. Self-employed professionals, because they pay both halves. Small business owners with payroll, higher CPP expenses per employee. Incorporated owners paying salary, since CPP applies only to salary, not dividends. This is why many tax planners are shifting incorporated clients toward dividend-heavy compensation strategies. Because dividends skip CPP entirely, and that's where opportunity lies. The Win It Back Blueprint. 4 ways to offset CPP 2. Now let's talk solutions. Because this channel isn't about complaining, it's about strategy. Here's how high-income Canadians can win back what CPP 2 takes. The dividend strategy for incorporated professionals. Instead of paying a large salary subject to CPP, pay yourself primarily through dividends. You avoid both employer and employee CPP portions. Yes, you lose CPP credits, but redirect those savings into a personal TFSA or RRSP. You're now building your pension, not Ottawa's. 2. The TFSA and YAMPE FHSA expansion. Use the extra $7,000 TFSA room in 2025 plus FHSA if eligible. Tax-free growth beats locked pension growth every time. Treat these as your CPP alternative accounts. Maximize RRSP contributions. Strategically, CPP 2 reduces take-home income, but RRSP deductions can neutralize the tax hit. Run contribution scenarios that offset new CPP withdrawals. 4. Corporate pension or IPP, individual pension plan. For incorporated business owners, set up an IPP to grow tax-deferred assets under your control. You get similar retirement security, but you're the trustee, not the government. These 4 moves can not only recover the liquidity you lose, they can multiply it. Case studies, the 3 Canadians. Let's see how this plays out in real life. Case 1. Sarah, marketing manager, $85K salary. Her CPP deductions rise by $750. She counters by increasing her TFSA auto deposit to $65 a month. Over 25 years, that grows to $60K tax-free. CPP 2 gives her $20K in benefits. She wins. Case 2. Arjun, incorporated consultant, $150K. Income. He switches from 100% salary to 70% dividends, 30% salary. Avoids $1,200 CPP contributions per year, redirects into a corporate investment account. His liquidity grows faster than his CPP would have. Case 3. Nadia, dentist, self-employed. Pays both sides of CPP. Painful. So she opens an IPP contributing pre-tax corporate money. Creates her own pension with full investment control and tax deduction. Same rulebook, 3 results. Planning decides who wins. The emotional reframe. Don't fight it, outsmart it. Here's the truth. You can't stop CPP 2. It's coming, like taxes, inflation, and winter. But you can prepare, position, and profit. The people who lose are the ones who stay reactive. The people who win are the ones who adapt early. Treat every new policy like a market signal, not a penalty. If you learn to reverse engineer government policy, you'll never fear Ottawa again. So instead of saying, "They're taking more from me," say, "Time to build my counter strategy." Let's recap your CPP 2 playbook. Understand the new YAMPE ceiling, up to $81K. Expect a $750 less take-home pay in 2025. Use dividends, RRSPs, and TFSAs to offset it. Incorporate IPPs or corporate structures if you can. Start acting before January 1st, 2025. If you found this breakdown helpful, drop CPP plan in the comments, and I'll send you my free CPP impact calculator to project your 2025 paycheck. Subscribe to Financial Mo. We simplify Canada's financial chaos into strategy and control. Because in the end, money doesn't reward complainers. It rewards planners.